What is up? Welcome to the channel. In this video, I'm going to be talking about why a one-to-one win rate can actually make you a ton of money. So a lot of people, they think you need like some crazy like 10R system, okay, to actually be profitable. But really, all you need to be profitable is a one-to-one. Like, you guys don't need to hit 10Rs. You don't need to hit 5Rs. You don't even need to hit 3Rs, right? You can be highly profitable using a one-to-one risk-reward system and maintaining a 50% or better win rate, right? And so the beautiful thing about risk to reward and win rate is you can tweak it, you can adjust it per your strategy. My strategy really focuses around, one-to-ones, letting them run. So it's a high win rate strategy. I would say on average 50 to 70% win rate. Um, and it pretty much guarantees a one-to-one and then lets things run, whether it's the whole position or some runners, right? And so why this is powerful is because if you run the math on this, you quickly realize that this becomes a profitable trading system, right? So my model that I trade is called the Mike model. Like I said, it's 50 to 70% win rate. Produces a one-to-one pretty much every time. Sometimes I hit a 2 or 3R. So you could, on the low end, you could say it's a 50% win rate, and on the low end, you could say a 1.5R, right? So that's low end, right? That's not even like good price action on a good day, right? So why is this model actually super powerful? It's because you can still get a one-to-one or a high win rate, and as a byproduct, you're still getting more than one-to-ones, right? You're still hitting those 3, 4, 5Rs, right? Can this thing move? There we go. All right. So you're getting one-to-ones. You're not giving up your win rate to hit higher RR, right? So you might get 3 or 4R trades, but you're not sacrificing your win rate. Usually when you go for a higher risk reward, okay, what happens is your win rate drops off a cliff, right? So with my model, you're still getting that high risk reward occasionally due to probability, but your win rate is staying static. You're still maintaining that 50% to 70% win rate, right? So as a result, you get what's called like a Nike swoosh, right? And let me see if I can get a drawing tool going here. Is this it? No, that's the wrong one. Okay. So as a result, right, of getting those consistent base hits, those consistent one-to-ones, right, your equity curve is going to look something like this, right? It's just slowly building, 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 and then you're going to hit those like 3, 4 hour trades, and you're going to get a boost. Slow, 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 slow in building, get a boost. Slow, 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 get a boost, right? So that's how your equity curve basically looks using this model. It's like you just consistently hit those little base hits, right? You hit a banger, and then you just maintain those one-to-ones. You hit a banger, right? And you're just continuously doing this, right? This system keeps you safe, right? It's perfect for prop firms because if you have limited drawdown, you don't want to trade a high RR. You want to trade something that's consistently keeping your head above water and not putting you into the red, right? A lot of these prop firms, you get punished for ending a day red, right? Whether you follow your rules or not, end of day or intraday drawdown is going to get you, right? So you want something that is going to consistently end you on a green day or at least break even, right? And so that's why the Mike model works really well because that's exactly what it accomplishes. But you're also getting that high RR without giving up your win rate. So this is where the magic happens, right? So my model or my philosophy is one-to-one, let it run, right? With the Mike model, I'm always going for a one-to-one. That's my goal. And if I can get more than that, I'll go for more than that, right? And I'll let things run. Now I could, there's two situations that can happen. When I go to TP or when I'm ready to TP or I'm letting things run, either I let I let the whole position go, right? The whole, can't spell apparently. The whole position run, right? Okay, and then just move my stop and profit to secure a one-to-one, right? So I'm guaranteed a one-to-one, and then I let probability take over and let things run if they want to go to like some crazy RR. The other thing you can do is if you want to play it safer and you want to just take your profits now because you just want to have some risk off the board, you want to secure something, right? And I get that it helps with psychology. It's also not a bad strategy either because there's many times where it can be advantageous to do that, and I go through that more in my training, my education, my courses, my mentorship. Link down below if you want to check that out. But sometimes what I'll do is I'll TP 80% of my position, and then I'll leave 20% to run, right? So the reason that I do this is because I'm pretty much guaranteeing the one-to-one profit factor, but I'm still leaving a little bit on the table so that way if things really run and get crazy, maybe we get some kind of tweet comes out, news, whatever, and we run 100 points on NASDAQ or whatever asset you're trading, right? You can use the same risk reward on options, futures, whatever, right? You can use it on individual tickets, you can use it on the index, you can use it on whatever, right? It's universal. But the point is you secure 80% of the position, so you're kind of guaranteed that 1-to-1, and you leave 20% on the board to run if you believe that it's going to continue to run and it can go crazy, right? And so that way, what you're doing is you're capturing more upside and you're getting a higher than 1-to-1 risk reward without giving up any kind of win rate, right? So your win rate is staying static, but your risk reward is steadily increasing when you do this, right? And that's why runners are really important. So, um, basically it's you're getting best of both worlds. You're securing profits. You're also giving yourself upside or downside, or technically upside in both cases. But you're giving yourself upside if the trade goes in your favor, whether you're long or short, right? Um, and there's been times where I've left 20% to run on a position, and I made like an extra 2 or 3 R from doing that, from that 20%, right? Risk-free, mind you, it's pretty much risk-free. You can also do the same thing with just moving your stop and profit. Sometimes I'll do that and I'll secure like 1, 2, 3 R, and I'll just keep bumping it up and I'll just let things go. But the point I'm trying to make here is we're not giving up our win rate to secure a high risk to reward, right? So usually when people try to top and bottom take, they might get like a 10, 20 R trade, but they lose, like 15 trades before they get it, right? And it's very stressful. It's very difficult. And it's very hard to trade that in prop firms, right? The reason this works so well is because you're still getting those like crazy RR trades with this model, but you're maintaining a static or consistent win rate, right? That is going to keep your head above water. So let's move into some of the math of this, because I could yap all day about this, but let's look at some numbers, right? So here's just some math. Here's a breakdown of just like basically a realistic breakdown of the math here, right? So assuming 1 R per trade, 52 wins, 48 losses, 80% of the position gets taken out at 1-to-1, 20% is a runner. Average outcome of the outcome on winners is 3R, or on the runners is 3R, right? And we're just throwing numbers out there, right? Like I'm just gonna assume 3R. Sometimes it can go 5R, sometimes it goes 10R, sometimes it goes 2R. We're just choosing 3R because that's like a good average, right? So for each winner, we're gonna take off 80% of the position. We're gonna leave 20% to run. So average win is gonna be 0.8 R plus 0.6 R equates to 1.4 R. Okay, so follow along with me. So each loss is gonna be 1 R over 100 trades. Your gross profit you can expect basically 52 times 1.4. 1.4 R is gonna equate to 72.8 R. This is your gross loss is going to be 48 times 1 R is going to equate to 48 R. So your net profit would be 72.8 minus 48 R equates to 24.8 R. Now, I know that's a lot of math. That's a lot of numbers. Like, don't get too hung up on that. But to break it down in the simplest way I can, right? Because I can get too technical about this, and it's just, I don't want to make it overcomplicated. Basically, using this model, what you can expect is after 100 trades, you can have a plus 24R profit factor, right? And this is just like the math kind of displaying that, right? So your profit factor is like a 1.5, or technically 1.52 in this case, right? This is profitable, right? This is definitely profitable. You can be profitable at a 1-to-1 with 50% win rate. We're maintaining a 50 to 70% win rate, and then on the low end, we're hitting 1.5 Rs. On the higher end, probably like 3 Rs, right? So like you can see how this is getting the best of both worlds, right? So your average expectancy per trade is gonna equate to basically like 0.25 R, right? And in dollar terms, this basically means for every $100 you risk over the course of 100 trades, expect to make $2,480. If you risk $300, the math just goes up, multiplies $7,440. 500 per trade, $12,400. $1,000 per trade, $24,800. You get the point, right? You can scale this up indefinitely. But this is basically the math, right? This is what I'm trying to explain to you, right? Without nerding out on math, and just explain it in simple terms, or just easier to explain terms, right? This is just math, and it's just showing like what I'm trying to say in layman's terms, right? So, basically, don't worry about this too much. Just understand this. Understand that at a 50% win rate at a 1-to-1 R, you're profitable, right? Or basically on the verge of profitability. You need to be like a 51% win rate technically, because of fees and stuff, right? So you don't just break even. But if you're hitting like 50 to 70% win rate and you're getting like 1 to 3 R, you can see how that tips the scales in your favor, right? That's how you get an equity curve that's steadily growing and then shoots up, steadily growing, shoots up, instead of something that is going to look like this, where you're just kind of like up, down, boom, bust, boom, bust, boom, bust, chop, 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 right? That's how you get this like Nike swoosh effect, is using a system like this that is consistently hitting base hits. But like I said, the reason the Mike model, which is what I trade, which is my proprietary trading setup that I teach my students. Link down below if you want to join the Discord, check it out. You basically get high RR plus high win rate, which is going to cause like that Nike swoosh effect. And to show you one of my students, this was posted in the Discord not long ago. One of my students in Masterclass actually sent me this showing me that across his fundeds and evaluations, he was trading my model and he's up around $18,000 in profits, right? Which is fantastic. That's amazing, right? And what's cool is he tracked this through TradeZella, so we can actually see some of the math behind it. And we can literally see the math playing out in real time, right? His win rate is like just above the 50%, so it's like almost a 51% win rate, but the profit factor is like a 1.6, right, or 1.59, right? So he's hitting get at least 1-to-ones or better, and he's maintaining a 50% win rate or better, right? Now this is just one case example. I've had students hit 70% win rates. I've had some hit 60, 50, right? It's discretionary trading, so it's going to be a little different for everybody. But the point is like you're maintaining 50 to 70% win rates, and your profit factor is 1-to-1 to, infinity. Like there's no cap, right? Like you can hit 10-hour trades using this model. You can hit 1-hour trades using this model, right? So basically your profit factor, has unlimited potential depending on market conditions, right? So what's great about this is, like I said, you're maintaining that 1-to-1, right? And that 50% win rate as your baseline, but you might get a 51 or 52, maybe even a 70, 60, 70% win rate, and you're still hitting 1-to-ones, maybe 1.5s, maybe 2 Rs, right? And so you're never giving up any, basically win rate to pursue RR, right? So you're getting great risk to reward, you're getting great win rate, and that's why you get like this Nike swoosh effect. You can kind of see it here on his TradeZella. You can see it's steadily going up, then you get a big pop, steadily going up, you get a big pop. That's what I'm trying to explain here. Like that's basically what the model does, and that's why it's good for personal accounts because it's low stress, right? It's good for even prop firms, especially because you have limited drawdown. So, and it's universal. You can use this across different markets, right? You can use this on options. You can use the same system on futures. I'm sure you could use it on other assets as well, but I mainly just trade options and futures. So, that's basically the math behind it. I mean, that's how you basically build a profitable system, is you have some kind of mathematical foundation to it. Because here's the thing is like, you guys can't fight math, okay? You need math to be on your side, and that's what this model does. That's why the Mike model is so powerful. If you guys want to learn more about the Mike model and get mentored by me and access some of my education, link down below. You guys can join the Discord. You guys can come hang out for free. It doesn't cost anything to join, but if you want to get mentored by me, I do offer that. So link will be down in the description of this video.